Either way, it looks like we are not getting onto Twitter today. So I don't know what's going on with Twitter. It just doesn't want to do a live today. Don't know why. But I will reshare this later for people on Twitter. You guys can check that out in a little bit. Um, but first off, let's see. Oh, I'm all over the place. Single screens, man. Single screens. Problem with single screens. So let's go over the commodities market, Sam, because there's a bunch of interesting things kind of happening. And number one is natural gas. Natural gas. We were just talking about this one. It's been a huge winner for us this year, up 50%. Coffee up 25%. Still a good trade. It started to slow down a little bit. I think a lot of people were like either expecting things to rip forever or not. Coffee since the bottom, what's it up 200% since November 23? I mean, it's been a major move. It just doesn't move like something like natural gas, which just explodes higher sometimes or explodes lower. A little less volatile than that.
I don't know if that's
Copper.
really true, Jason.
Go ahead.
We've seen like cocoa. I mean, how big was that move in such a short amount of time?
Cocoa's a
Like,
smaller market, though. It's smaller than coffee. Not saying it's a small market. It's just smaller than coffee. So sometimes those moves can be a little bit more explosive in something like cocoa. Whereas coffee, I think it's still an explosive move. I think people just are in their heads like this isn't enough. Like I think that's crazy because 25% year to date. I mean, if people are all performing at 25% year to date, they'd be very happy. The S&P 500 is down this year. So if we're looking at the S&P 500, if you look at the bottom end of this, see the S&P 500 is down 4.67%. So almost 5%. So we got crude oil down even more than that. Nikkei, which is the Japan Stock Exchange, is down almost 8%. The Nasdaq is down almost 8%. Russell 2000 is down over 9%. I mean, so you're seeing these like moves that are just massive losers on the equity side. And, we've been talking about this for a while, which is the tech trade. And so many people have this in their head that the technology trade has to either go one way or another. It's either you're all in because AI is going to it's going to change the world and everything's going to be different. And once everything's different and AI is changing the world, we're going to make all the money in the world and you got to be long it forever. And really, my thought is it's not about it not changing the world. It's not about it not being good technology. It's just about the fact that, hey, sometimes things don't always go up forever. And that's all
and
like
Jason, I think it's a
as
lot of
simple as
like, I don't know. We all know that the Kansas City Chiefs are the greatest football team to ever play.
that.
And like the market knows that too. It's not just us. It's not a secret. They price these things into the market. Nvidia is an amazing company. They're still growing at an amazing clip. But the market knows that and they've priced it in. So it's a lot harder for it to go up because of the elevated expectations.
No, I agree. It's not with the Kansas City Chiefs thing, but with the rest of it. So I agree with that. That makes a lot of sense. It's just when people just start to expect things to go up forever, that's usually when things stop going up forever. And that's very normal. And there's nothing wrong with that. It doesn't mean like, it's the end of the world. It's kind of like gold, at some point gold is not going to. That's the thing. It's easy to predict if you're just like logical. Obviously gold is not going to go straight up forever. It's not going to blast through 3,000 and just hit 4,000 in, a few weeks without a pullback. Like these things are going to happen. It's the same thing as the AI trade. It was great. 2023, you got this huge breakout and the Nasdaq. It's continued for 2 straight years. Great 2 years in it. Now it's 2025. Looks very different. Looks like money's flowing straight out of that sector, right into international stocks, right out of the dollar. Like you could continue to deduct all of these things until you get to a point where it's like, okay, well, where is money flowing? And that's kind of like what we want to talk to you about today is where is money actually flowing? Instead of money just kind of going, okay, this is just an easy way of looking at markets. And I understand this and I understand that. You have to understand where money is flowing at all times. It's the reason why we look at relative strength all the time. And so first off, when I talked about the dollar had its biggest down rate of change day since 2022. And
Weak.
why I pointed or week. Sorry, I'm reading the chart as I'm trying to talk, and good job, Sam. Good job. So, anyways, so a 1 week rate of change is what's on the bottom of this chart. The top of this chart, this is the dollar index, and as you see, we had a nasty weekly candle on the dollar last week, and usually this leads to the beginning of a bad move. This doesn't mean there won't be bounces. This doesn't mean this thing can't bounce right here even. However, it does mean usually we see some follow through to the downside. The one that we saw that wasn't quite this big, or was larger than the move that we saw last week, happened in 2020. But the volatility of the market was obviously way higher than it is today. 2020, that was coming right out of that bottom. Basically, March 2020, you're talking about COVID. The market bottoms in mid March and basically starts to bounce. Everybody was panicking in the dollar during that crisis. That's why you see that spike back in 2020. And then it goes the other way very quickly. And that straight up move to straight down move changed the direction of that market. That rate of change was large. And then next thing you know, it consolidates and then it breaks down. And then it goes down for about a year and a half, basically. And then we get to the one that happened in 2022. That was the same exact time that the market bottomed in 2022. So basically, 2022, for those who didn't trade it, it's a very tough year. The S&P 500 went straight down. The only sector in the United States that went up was energy, but it went up quite a bit. I think it had a 50% year that year. So energy had a good year, but everything else had a terrible year. But then March comes and we get a bottom in October. Sorry, October comes. I'm getting the years mixed up. October 2022 comes, market bottoms, the dollar has this huge down move, and then next thing you know, the S&P 500 starts to move to the upside. Now, same thing here. Now, I'm not saying we're going to see this move in the S&P 500 coming up. I'm just telling you what market history looked like. But I think that what this is saying over everything else, and I can't tell you what the S&P 500 is going to look like from this chart or anything else, I can tell you that the dollar is probably going to head lower. And I think that that target down to 100 is going to be hit quick. I've been saying that for a while. The positioning unwind is just massive. So as that positioning unwind continues to happen, I think we're going to hit that 100 level in the dollar. And then we could maybe bounce a little bit, but I think it's going to break through that ultimately. Sam, what is your thoughts on the dollar?
Yeah, Jason, I think you hit the nail on the head there. This is a massive unwinding of offsides positioning. Particularly, the speculators have been dead wrong about this move. They've been betting on a stronger dollar, and boy, have they been punished for that. And this chart really doesn't do the move justice. Like, if you look at something like the Euro US dollar, last week was the best week since the great financial crisis was ending back in 2009. That's a long time ago. So that this move was a very, very big deal. And it wasn't just in the FX markets. You saw it in European financials relative to US financials. You saw just the broader markets, Europe relative to the US, best week ever. There were so many momentum thrusts last week. So it's really an exciting time to be a European investor in particular. And it's really been a terrible place to invest for a long time. So this is a nice change of pace for fund managers that invest across the globe and aren't just focused on US tech companies.
Yeah, so where are you looking at in Europe to buy? That's the thing that people continue to ask. Like, so if you're looking at Europe, you're always talking about Europe. Where are we looking in Europe to buy? That's a question that we could maybe answer here today.
Yeah, for sure. So the financials, I think, are the place to be. They have been red hot. They continue to be red hot. You can look all across Europe. It's not really just a single country story, but uh, anywhere you look, basically, you can find a bank that is attractive. And in addition to that, I think industrials are very interesting. You've seen this war rhetoric in Europe ramp up. The US doesn't want to spend money on European defense, though White House in the US wants Europe to pay for their own defense, and that's going to cost a lot of money, and that's going to put a lot of money in the pockets of shareholders of these industrial companies that are going to help make that happen. So you can look at something like Rolls-Royce that is building the jet engines, or you can look at something that's much more picks and shovels. Something like a company that constructs a road or a bridge or something very basic like that. But there's a lot of opportunities in rebuilding Europe's infrastructure right now.
Ferrari, like that's another one that keeps coming up for me on my scans over and over again is Ferrari, whether it's a fundamental scan or a technical scan. And I find that like almost hilarious to see this thing again and again. It's been on my list for like ever because it's just come up and I'm not a stock guy, but it's like something that, you can hold in long-term portfolio. It's the most, if you look at that stock, it's like, what happens to this thing that it even can go down? Can it go down? It's the weird, if you look at that stock, like just put in the ticker for you guys, the ticker's RACE, RACE. When you guys see that, you'll be like, okay, this thing has just been in an uptrend forever. It just doesn't go down. It's the craziest thing to kind of look at, but Italy does have a lot of interesting things going on. Somebody said the other day, and we could address this here. They were talking about what is it called? They were talking about my international stocks, and they were like, you have all these terrible, they said shitty ETFs that are illiquid and blah blah blah. And it's like, dude, unless you're a $30 billion or somewhere around that range fund manager, you're not going to get stuck into any of these things because of liquidity. Like that's the truth. Like you will not get stuck in any of these things because of liquidity. And I think that so many people have this like fear of illiquid products that they don't know what is a liquid and what isn't. Like that's a liquid is if you're looking at an ETF and there's nobody trading in and out of it. There's no options on this thing. There's nothing out there to trade it. Sure, that's an illiquid product. But if we're talking about like EWI or any of these European ETFs, like they have enough money flowing through them that you're not ever going to be stuck into a trade unless you're running some crazy huge fund that I don't know of. So I think that the nice thing about being an individual investor or even like myself having a small fund, when you have a fund like when you're not managing something over 100 million, that's the label for a small fund. Under 100 million, you basically have the option to buy products that some people would say are illiquid or other hedge funds that are very large, like Ray Dalio, for example, or any of these guys couldn't buy. So you can take advantage of those things. But getting into to the point of like, hey, I can't buy this because it's a liquid. Like not every ETF is as illiquid as the S&P 500. That's the damn truth. And that's just going to always be the case. But however, like you don't need something to have daily options to be liquid. You don't need it to. You need the ability to say, hey, I want to get out of this thing. It's crashing, and the ability to get out quickly. Like that's it. And so EWI does that. Any of the European ETFs do that. Any of the Asian ETFs really do that as well, whether it's Vietnam, China, Hong Kong, whatever it is. EWA, which is South Africa, it's liquid enough. EWZ, which is Brazil, that does it too. I could go on, but like all of these are plenty liquid for anybody to trade who's trading anything under $100 million. Now, if you guys are, watching the show, I appreciate you huge hedge fund managers watching the show and talking to me about these things. But I just have a feeling that nobody's running, over 100 billion that's watching the show today. Just a thought.
You're probably right, Jason.
I might be right about that, but you never know, Sam. You never know. So let's get back to the charts. So looking at the next one. Now, this is a chart I took from Sam basically and just threw a band squeeze on it. Totally jacked it from Sam, and no problem saying that every time.
Hey, I don't copyright charts, Jason.
I know, but I totally jacked it from you and just threw it. I was wondering if it was squeezing, and I threw a band squeeze on it. So basically, if you look at this chart, you're just kind of looking at the gold to the S&P 500. Now, so many people look at this chart and they're going, oh my gosh, you're so bullish on gold. And yeah, I'm pretty bullish on gold. But something that I'm even more what I'm trying to really articulate with this chart is the fact that most of the time when you see this type of outperformance in gold, the S&P 500 isn't doing that well. And it could be for a majority of reasons. It could be right now, I think the weighting in technology is going to put so much pressure on the S&P 500. It's going to be hard for it to go higher. In 2000, it was obviously the same thing. The S&P 500 was obviously in the middle of the tech bubble. Technology stocks continued to become a bigger and bigger part of the United States economy. As that continued to move higher, and then that tech bubble burst in 2000, money started flowing into gold. Is that the exact setup today? It kind of seems like it. It seems close. Do I know that, how long it's going to last? Because once again, this was a almost 15-year bear market that happened after 2000 in technology stocks. I don't think that's anything that we're going to see today, where we see a 15-year tech crisis. I can't see that happening, but I do think that precious metals are a great place to be. I think they continue to be a great place to be. What do you think about the S&P 500 and gold, Sam?
Yeah, this looks like the beginning of a new period of outperformance for gold relative to stocks. And we've seen this in history last for not just a few months, a few quarters, a few years. This tends to last for close to a decade. So, this is really a big change for investors. And it's not going to be easy for a lot of them. So, I expect tech to underperform for a significant amount of time, and that makes sense. You look at something like Europe, with their best week ever relative to the United States last week. And what is Europe? It's not technology. It's a lot of different value areas, like financials and industrials, and that's kind of what gold represents, is these more value areas. So I think that is the place to fish right now. And you're seeing it across the board. These precious metal miners are popping off, returning a tremendous amount of money to shareholders. And I don't think there's a better place to be right now.
No, I like that. And just so you guys know, we're actually just got on Twitter. Twitter, I guess, got their live thing fixed. So we're on Twitter now. Sorry
Nice.
about the delay, guys. Um, that wasn't on me. Wasn't on me for once. Usually I'm the one messing stuff up. Wasn't me today. That's good. I'm going
You're
to
good,
mention that a
Jason.
million times. So get to the next one, Sam. So we're talking about this United States underperformance, global outperformance. Nobody gives a shit. Everybody's like, yeah, I'll believe it when I see it. I had somebody write, yeah, that's a good couple day move, but it's not something that happened over the last, I'll believe it when it really happens. It's like, let's talk about one thing. China. What happened last year? China outperformed the S&P 500 last year. A lot of people just still are just overlooking that, completely. China's 12-month performance is 60%. That's 60%. Okay, pretty good, pretty decent.
That's like natural gas.
Yeah, yeah, China's basically performing in line with natural gas this year. So, I mean, it's a really really nice move from China. But the year to date returns are something that I always want to look at. And the reason why I look at the year to date so much is because it's telling me where money is flowing now. And what happens is fund managers, the big funds, the ones that are over 100 million, they take their money at the end of the year and they do tax loss selling, or they take positions off. Some of them just go on vacation for Christmas and they start to sell positions like crazy. I mean, there's a bunch of reasons why you see little sell offs at the end of the year, and then why you see money flowing into different areas at the beginning of the year. New allocations come in, new money comes in. Somebody who had good performance last year, they start to give you more money for the next year. There's a million reasons why. But then you start to see year to date returns. Where is money flowing? Now, month one, sometimes you get a little bit of a false move. Month two, you can have a little bit of a false move as well, but you're starting to see where money's really flowing. Now we're on month three, which we're in March. Poland is leading the way. So, once again, I'm not saying everybody go out there and buy Polish stocks. I do have ePoland in my portfolio. If you guys are on our service, you guys see that on our Substack channel. You can see the portfolio every week on Wednesdays. We also have KWeb, which is the Chinese internet, up 30% year to date. Looking at like Austria, you're looking at European financials, which I can't really be bearish on global stocks if European financials, which have been historically terrible for a very long time, is up 25% year to date. China up 25% year to date. Germany up 22% year to date. Spain up 22%. Italy's up 20%. I mean, I could go on and on, but we're just looking at this market just looking completely different than the S&P 500. So if you go to the right side of this deck, and thanks Ricardo for building this, is a really great deck he built. If you go to the right side of this deck, you're seeing that the S&P 500 and the 90-day chart just basically started trending straight down at the end, probably mid-February. It was right around that options expiration week. That's another thing to talk about. When you see options expiring on top of futures expiring, which happened all at the same time in February, basically right exactly around that peak, you see a lot of sell-offs happen. This is why you see sell-offs in February happen quite a bit. The one that brought on the COVID crash started in February, right around the options expiration week and the futures expiration week. But what we didn't see that time, and why it's different this time, is that the international stocks are going the other direction. Like, as the sell-off was happening last week, the rest of them started to rally again. That's really phenomenal thing. It's really a phenomenal thing to see. And look at the uptrend to downtrend. So if you look at the price trend, you'll see the 21 day moving average, 50-day moving average, 200-day moving average. In the United States, the S&P 500 is below the 21 and the 50. Now, this was from last week, so we were above the 200. Now we're actually below the 200-day moving average today. But look at the rest of these international stocks. They are up. They are moving higher. They are trending. So, you can keep saying that, hey, this is just short-lived or this isn't happening and close your eyes, but it is happening. And really, at the end of the day, the goal has to be to make money. Is our goal to make money? And if our goal is to make money, then we want to be wherever we're making money. We don't care if it's the S&P 500's going down and we feel un-American for buying China. My goal is to protect my clients' money, and that's what I do. And here we are, and we're making money this year, and the reason is because we're buying international stocks. So what are you thinking about the international move, Sam?
Yeah, Jason. So I think back to the last cycle, the post-COVID bull market. And really the biggest winner was the dirtiest stocks. You wanted coal stocks, filthy, dirty. Those stocks were amazing. Right now, I think the move is to buy stocks that have a lot of communism. You want more
Commie
communism
stocks.
in your equities and less democracy. And that's not easy for people to wrap their minds around. Go back to 2020. Why are coal stocks outperforming? Why are they going up 20,000% in a straight line? Shout out Alpha Medical Resources. It took a lot of people, a significant amount of time to come around to that move, and that's really what fueled the uptrend, is just climbing that proverbial wall of worry. So I really think that's the setup here, with not just Chinese communist stocks, but you have a lot of socialism, communism, that type of vibe across Europe. So I think they're just going to continue climbing that wall of worry, and this is the start of something really big.
Commie stocks. I love it. That's hilarious. And honestly, it's funny because it's you go visit certain places and you see, like, I think what's interesting about markets is what they really do, and they kind of look at rate of change over everything, whether it's you're looking at an actual chart or you're looking at actual economy. And so sometimes it's the rate of change. Like, you're looking at let's say it's the most socialist country in the world. Let's say it's the Soviet Union. If they're coming out of, the most communism you've ever seen and trying to move towards a kind of more capitalist system, even though it might not be like capitalism as in like completely free market, you're going to see people flood into that economy. And so, like, I know some of these other economies have been kind of moving in that direction. Argentina, it's one that's trying to move into a more capitalist direction. Brazil, it has we used to be, it got a huge. There was a lot of turmoil in Brazil because of that, so that was another thing. Um, but all these countries that we're kind of seeing moving, I wonder if there's a rate of change of less of this structure kind of coming into play, or if it's mainly just, and this is what I fully believe, which it's just a play on the dollar. If we go back to that dollar chart real fast, you're just seeing, this move is so correlated with the dollar.
And so,
So
Jason, one thing that JC has been bringing up lately is that this massive unwind in the US dollar has increased the acceleration of the uptrend in places like Europe. Do you think that's the case? Do you think this rotation away from United States equities has been accelerated because of how bad the US dollar has been?
yeah, I do. I completely agree with that. And I definitely think that the dollar looking like this, most of the time when the dollar is in some sort of down move, I mean, even go through 2020, 2021, like China does pretty well in those periods of time. The dollar's been in almost an up cycle since the great financial crisis. Basically, once we got to about 2010, 2011, we're looking at the dollar kind of being in an uptrend with very small periods of downtrends. One was 2020 through 2021, which you can see on this chart. The other was 2017. So you could see a couple of those downtrends in the dollar where money started flowing internationally again a little bit, but it was always very short lived. This one seems so different for a couple reasons. One is its ability to kind of shake some of the dollar moves. This dollar was very strong at the beginning of this year. The dollar was very strong at the end of last year. Um, and China still was one of the outperforming countries last year, up 30% in 2024. So if we're looking at those things all together, I just think this move has legs over everything. I don't know how it's going to go, if it's going to be perfect. I just think this move has legs. And the way you trade these things is you don't look at it and go, well, I know that hasn't happened for a long time, so it can't ever happen again. I could give you a million things that have happened to me in my trading career that everybody thought could never happen again. Gold going up was one of them. Gold was in a bear market for many, many years. 2018, gold bottoms at the same time as bonds actually bottomed. And next thing you know, gold's moving up all the way to today. It's still moving up. Gold was 1,200 around that time. Gold's all the way up to almost 3,000 these days. So once again, that was a huge move. Cocoa was never going to break out. Cocoa was stuck in a range for probably going back 15 years. It was a
And then they
long.
said these other soft commodities couldn't do the same thing.
Yes, and then the other
Talking to you,
softs wouldn't
coffee.
follow. Yep, then coffee starts to follow it. Go to 2020. There was no commodities will never go up again. We have enough technology that we're in a deflationary cycle for life. And then oil makes one of the after all the oil investors were actually done with it because they got their asses kicked for many years. Basically oil starts to make this huge move all the way from negative 50 in the front month contract all the way to $130 at the high. So then oil makes a big move. Energy stocks, everybody hated energy stocks, and 2020 happens, and they even looked like crap through most of 2020. They made a little run after the bottom in after COVID in March 2020. They made a little run, they pulled all the way back, and then November, right after the election, for Biden, which is, I bring that up only to say most people wouldn't have thought that that was going to happen. So Biden gets elected. Next thing you know, energy stocks are just moving like crazy. They were the outperforming sector over that 4-year period of time, and they were the outperforming sector in 2021 and 2022. So, when you go back and kind of look at these things, it's like, don't think things can't happen. That's the biggest thing to fade in yourself. And that's one thing that I always talk about trading wise. Like, you got to sometimes fade yourself. Because, like, to me, I want to think the same thing. Hey, I don't know about these Chinese stocks. It doesn't even matter because look, we're in profit now. We're in a lot of profit. Let's say that it turns around and like this whole thing was a dud. Who cares? I still made money. Like, so, like, is the goal to make money or to be like, hey, in 5 years, look how right I was? And so you
No,
have
it's
to
so
understand
true,
the difference
Jason.
in
Like,
that.
I don't know. I've read all the Market Wizards books, and like the one common denominator between all these guys and girls is they're all open-minded. It doesn't matter if you're trading based on the moon and stars, you use
Yep.
Fibonacci, you're purely driven by fundamentals. It doesn't matter what you use to analyze the markets. It just matters that you remain open-minded to different outcomes. And I think that's
Yes.
exactly what you're trying to say.
Yes, exactly. So as long as you're open-minded and you understand that the market can do whatever it wants to do and you don't control that, you'll make money. But if you're sitting in these positions and you're going, this can't happen or this has to happen, and I know why, you just don't know. And sadly, that's just the truth. You don't know the future. I don't know the future. I can tell you, hey, this is what should happen with a high probability bet. This is what can happen even on a low probability bet. I could tell you both sides of it. But at the same time, the market will do what it wants to do, and all we can do is follow it. And I think that's what you and I do well, which is following the charts tell us where money is actually flowing, as opposed to what people are saying. People can get on TV and talk their book every single day. They can say, "Hey, the I believe the United States is the best stocks in the world, and I'm just going to hold those forever and ever and ever." And you could look at their 13F portfolios and see that it's completely set up completely different than that. You would think that an investor that talks about the United States all the time would only be invested in the United States, but that's just not true. And then look at the fact of, the all weather portfolios. There's another great example. If you look at an all weather portfolio, and this is Ray Dalia's portfolio, basically the idea behind it is it can go up in all different types of environments. There's never one of those I've ever seen historically that just says zero international stocks. I've never found it. Every single one says international stocks have to be in there. Now, why after 10? Because this is what everybody goes back to after 10 years of underperformance. And it's like, yes, because go back before those 10 years. People don't do that enough. They look at the chart, they pull up a chart of, China or the United States to Latin America or whatever, and they go back a few years and they're like, oh, this is crap. But then if you go back further, go back all the way to 2000, see that rally, see that the S&P from 2000 to 2008 basically was flat. I think it was up 27 basis points. But then if you go to Latin America, it's up 600%. China, it's up 300%. Oil was up even more than that. It had a 30% CAGR all those years, hit 1,000% from 2000. So once again, understand that you just got to rotate assets sometimes and you don't have to like it, but if you like making money because like it beats the hell out of being broke, like you don't want to, if you have $0 in your account you can't trade anymore. And I know most people here are passionate about trading. They love trading. And so the idea is to protect your money at all times, even if it's things you don't want to do. And I'm totally good with doing things I don't want to do. That's kind of like my life goal most of the time. When you don't want to do things, it also helps your brain grow. It's the reason why people talk about cold plunging. Cold plunging sucks. It's terrible, but I do it all the time. And the reason is it helps my brain grow. Do things that you don't like to do. So, real fast, I don't know how much time we got left, only a little bit. But let's go over the bond market and lumber, and then we'll get on the gold rush, Sam. So, what are you thinking about the bond market? It looks like we're seeing some strength in some of these areas. I feel like people are getting a little too bullish on bonds, like it's all good forever and ever and ever now, and we're going to head to this lower rate environment. But I also think the bonds are saying something. So why don't you speak on that, and then I'll come back, and then we'll get off of here.
Yeah, I think we've seen quite the decoupling from U.S. equities and bonds. We've been in that kind of environment where stocks and bonds move tick for tick ever since the COVID crash, and that has really changed as of recently. And what I really think is going on there is the market has been kind of afraid of inflation these last 5 years, And I think this recent change in the relationship between U.S. equities and bonds really signifies that the market's less worried about that, and they're worried about some type of crash in the economy, some type of recession. I think the biggest data point you can point to in the economic data is the U.S. Unemployment rate, which I think we've all seen the chart. It's starting to curl higher, and when it does that, it starts to explode higher. It doesn't, um, these moves are real in the unemployment rate. So I think that is kind of what the market's looking at. So I think there could be a significant amount of strength in the bonds here going forward. Do you think I'm crazy, Jason? What do you think about that?
No, I like your thought. I think that there's two things about it. One is when you look at the bond market, I think it's trying to say something because I've always had two thoughts about where we're at this year. I think we're either very close to a deflationary shock, and then that's times like COVID, 2008. Not saying it's going to be as big or as massive or any of those things. I'm just saying like deflationary shocks usually happen when there's a liquidity event and people need money very quickly. So you'll see everything sell off kind of all at the same time. Sometimes bonds even start to sell off at the end of that. Think about COVID. Bonds were going crazy higher, and then all of a sudden they started going down towards the end of that market crash. So I think a deflationary shock is possible here. And so money's kind of flowing into bonds thinking about that. And so I think a liquidity event could happen. But I think the Fed had reacted a little bit too much here. I think they raised rates a little too high. I think they didn't lower them fast enough. And I'm not saying for inflation. For inflation wise, they did exactly what they needed to do. For the commodity or for the economy and unemployment, as you're talking about, they didn't do any help for the unemployment rate. And so if they're going to do something for unemployment now, I think they have to really start to cut aggressively and continue on that path to get us out of a period of recession.
And I think
Um,
that's exactly the thing, Jason, is like
mhm.
they're aware that they're being too tight with their policy, but that's fine. If something breaks, they're gonna unleash the money guns, and you know what to do when that happens, right? Like,
Yes, and that's where I'm at on this is like,
yeah,
okay, we're already seeing this dollar crash thing. We're already seeing money flowing international stocks. We're already seeing gold, copper, silver raging. They love this environment. They're loving it. If we got to a period where, whether it's a quick sell off and they go, oh my God, we got to come in here today and start to flood the market with liquidity again and start to lower rates and so on, commodities are going to go nuts. Inflation is going to go insane. And so that's the thing why I think it's good to think about this in two ways. One is we could have a little bit of disinflation and a bit of a liquidity event in the market, and that could be already starting right now. But if they're going to come in and react, that's going to be the thing that really spurn the commodity cycle and move everything a lot higher, especially commodities,
especially commodities.
especially
Go to that
commodities.
lumber chart. This is a sweet setup, Jason. So is lumber liquid enough for you to trade? I know there's
Oh yeah.
some constraints there. So they changed the contract. When was that? Late 2023?
Yeah, so they changed it in 2023. They wanted to make it a little bit cheaper, a little bit more liquid, so more people would trade it. And it is. It is a little bit more liquid. More people do trade it. It used to literally be, and if you're trading, a few contracts at a time, they're still pretty. They were pretty big size back then, but still a few you could trade in and out of them just fine. However, you still had limit up days, limit down days. Nowadays, I haven't seen many limit up days or limit down days in lumber. It feels a lot more liquid. It's a much smoother ride. But I also like the idea of owning some of the stocks out there that will benefit from this move in lumber. Looking into the Wood ETF, International Paper. It's a box company, basically, but at the same time, they have forests where they build. have trees, and basically they're able to take the lumber from there, and so they don't really get hit by lumber costs. So they're actually doing better by they actually also sell lumber, so they're selling lumber to other box factories or other people who need them, and then they're making money on that, and then they're able to save money for their own operations. So it's a pretty lucrative business in that. And if you look at that chart of International Paper, I had it on my Substack the other day. You're seeing a massive head and shoulders pattern with a V bottom in the middle, set up to basically break out, and who knows where this is going to go. And lumber looks very similar. So futures traders, I do I do own lumber personally. I think it's a great trade here. But I also think there's plenty of opportunities if you look inside the wood ETF and find different companies inside of there, like Weyerhaeuser, International Paper. Find the ones that have forests themselves.
I love when you talk about lumber to me, Jason.
Everybody loves it. Everybody's like, why don't you talk about lumber every day? That's what I get all the time.
Nobody cares about your precious metals,
Yeah,
your international stocks. They want to know about lumber.
Everybody loves to hear about lumber, Sam.
For sure.
You're
And one
absolutely
thing
right
I
about
think is
that.
really interesting with this market right now is if you overlay lumber with something like the home builders ETF, XHB or ITB, they trade tick for tick historically, and right now you're seeing those ETFs flirt with the resolution of prolonged distribution patterns. And meanwhile, you have lumber coming out of a textbook bearish to bullish reversal pattern. So I think that's a really interesting dynamic to watch right now. Kind of ask the question, who has it right?
And lumber likes lower yields too. Lumber does like lower yields. Obviously, that puts more pressure on housing. So, there's always a commodity. People always think like the commodity cycle has to look like this or that or the other thing. And it's like, no, there's always a commodity to buy out there, and there's always one to sell. Whether we're in a bull or a bear market for commodities. 2 years ago, we were in a bear market for commodities, and cocoa was the best trade of the year. So it's just you got to figure out where you want to be, pick your spots tactically, and also just trade all over the place. Like I don't understand why so many people are so stuck in I got to trade this sector. Oh yeah, I'm a tech investor. Yeah, I'm a gold mining bug. Like dude, there's so many things out there to trade. Trade every single thing you can, and that's how you make money. So, all right, guys, we'll let you go with that one. Sam and I are in a gold rush in a little bit. For you on Twitter, I don't even know if this thing ever even came onto Twitter. So, if you guys want to send a message and let me know if that even made it to Twitter. We did get wait. I did see some comments. So sorry about this, guys. I had this thing up trying to figure out Twitter. So we did get the Gatling Gauntlet.
I love that, Wavy. Yeah.
And then Nick mentioned looks like a beginning of a secular bear market. And so I do think that I was reading. Nick had a good report this morning for you guys who don't follow him. Nick Tomas, the economy tracker. If you want to put your link in the comments on YouTube so people can find you. But he put out a great report on tariffs the other week. Another one today on what the economy was looking like. Also saying there's some problems with the economy today. And so it's great for me to like wake up, read something like this, very fundamental stuff that I can kind of get a good piece of in the mornings and go on with my day. So you guys definitely want to check out Nick on the economy tracker. So, all right, guys, we'll see you guys soon. Sam and I will be if you are with Gold Rush, we will see you in about 10 minutes now. So, all right, guys,
sure.
see you soon. Bye.
See ya.